Hi, and welcome to Funding Juicy Solutions, where I talk about mortgage tips and strategies. Today I want to talk about debt to income ratio. Check out this video where John really sums up what I've been trying to communicate when it comes to advantages when meeting with a mortgage broker instead of a bank. I was talking to you a little bit earlier today about Fannie Mae and Freddie Mac.
Yeah.
So Fannie Mae and Freddie Mac are private institutions that lend money on the secondary market, which is a whole nother episode, that are guaranteed or insured by the government. They have guidelines that a borrower has to meet if they're going to lend out the money on that loan. One of the guidelines for Fannie Mae is if you're self-employed, you have to take the last 2 years of tax returns, not just bank statements, but tax returns, average them over 24 months, and then that's your monthly income that you apply to your debt to income ratio.
So just what other, areas of guidelines do you have an advantage in?
So, for example, I'm glad you asked that because that's the whole point I was going with this story. Say we take this 12-month bank statement loan, well, that one can go, say, down to 660. Or maybe there's a lender that'll go down to 620, whereas Fannie Mae requires 680 is the minimum FICO credit score. Or let's say Fannie Mae says, okay, well, self-employed borrowers might be a little bit more risky or whatever. So we're going to say the credit score. Let's say the debt to income ratio can't be higher than 40%. If you're over 40%, that DTI guideline, then we're not going to give you the loan, or we're not going to buy the loan from a lender. Well, this lender is saying, you know what, we're not selling to Fannie and Freddie, and so we're actually going to bump that DTI up to 50% or 55%. And then another thing you can also look at is a bank will say, okay, your FICO has to be this, your debt to income has to be this, whatever, they have their standards. Compensating factors, that's an industry term in the mortgage business. Compensating factors means, you know what, maybe your debt to income is 60%, but you have the 800 credit score. Well, a lender's going to look at that and say, okay, you know what, your debt to income is really high, so you're a risky borrower, but you have proven over time that even though things might be tight or whatever your financial situation is, we're going to trust you, and we're going to trust that you have the ability to repay your loan because you have an 800 credit score. So we're going to look at that 50% guideline or 45% guideline and say, you know what, their credit score is up here, we're going to go ahead and bump it up.
Okay. So I think I'm getting a better grasp on it now, Juice. So most banks are conservative, meaning that they don't take risk on...
They take minimum or less risk.
They take less risk by not going outside the Fannie Mae Freddie Mac guidelines so that they have the option to sell their loan to Fannie Mae and Freddie Mac.
Yes.
But you have access to other lenders who are less conservative, are willing to go outside the guidelines and do lending where they don't have the option to sell the loan to Fannie Mae and Freddie Mac.
You just wrapped everything up in like 2 minutes.
Okay.